Hi everyone, I'm Fabio, CEO and founder of MenthorQ. Today you're about to discover a new exciting product development that we've been working on. We at MenthorQ are thrilled to be the first in the market to introduce gamma levels on futures options. While some platforms offer a proxy for future using index option, we are providing access to our models by looking at the futures option chain, making the data cleaner and more accurate. This isn't just another tool, it's a game changer for traders who want to leverage market volatility to their advantage. In the next 30 minutes, we're going to discuss why future options are so important and how you can take advantage of them. We are going to introduce you to gamma levels on futures options and show you how some of our customers are using them to be successful. Then we're going to close the webinar with a product demonstration. As a futures trader, the biggest challenge is managing market volatility. Futures carry leverage and we can see significant price swings that can lead to large gains or losses. So risk management is key to be successful. This is where the MenthorQ levels on futures come into play. We are going to show you how to better identify market reaction zones that will increase your precision in identifying trends, reversal areas, and take profit targets. These reaction zones will not only help you better identify when to take a trade, but also when to stop and better manage your risk. Before we get started, I want to tell you a little bit more about my background. I have over 17 years experience in the financial markets and fintech, and I had the opportunity to work closely with the largest banks, asset managers, and hedge funds in the world. The bulk of my career was at Bloomberg, where I started to understand the importance of data, before moving into fintechs that leverage data for alternative investment strategies. This is why I created MenthorQ. Our company is powered by a team with unmatched expertise and diverse backgrounds. At the core, it's composed of ex-investment bankers, researchers, quants, data scientists, and developers. This unique blend of experience allows us to build and always improve models in markets that are constantly changing, providing our customers with the support they need to be successful. And this is why we are now so excited about this new product launch. We build quantitative models and data that we provide to our users daily, and the goal is to use the same approach used by large institutions. Leverage a data-driven approach, simplify complex data, and create actionable signals that can help us improve our performance and manage our risk more effectively. We now provide our users with quantitative models and data previously exclusive to large institutions. Our goal is to make high-level trading strategies accessible and actionable for traders like you. Let's start by introducing what futures options are and why you should learn about them. Options are becoming more important for investors. Even if you don't trade options, you need to be aware of how options can affect the underlying price. In 2001, options volume surpassed equity volumes for the first time. Options are becoming more important and this trend is here to stay, as we can see from this chart. Because of the increased volume of option and leverage that comes with it, a trader cannot afford to ignore these flows like before. Options volume have become one, if not the key flow that is responsible for certain price action, and understanding it will make you a better risk manager and a more successful trader. Now let's look at what futures and futures options are and why are they so important for any trader. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. The asset involved can be a physical commodity or a financial instrument. Futures have now expanded to include metals, energy, currencies, equity indices, and interest rate products, all of which can be traded electronically. So who uses futures? Futures traders are divided into two main categories. First, we have hedgers who use the future market to manage price risk. For example, an airline company like Delta Airlines uses futures on oil to protect themselves against price appreciation of the commodity they need to run their operations. Then we have speculators that use futures to increase their profit by benefit from the leverage that futures provide. Futures markets are important for hedgers to manage their exposure, but they wouldn't function effectively without the involvement of speculators. These participants provide much of the market liquidity, enabling hedgers to effectively enter and exit positions. So speculators range from full-time professional traders to individuals who trade sporadically. So what are futures options? Futures options are a type of financial derivative that grants the holder the right but not the obligation to buy or sell one future contract at a predetermined price with a specified time frame. These options combine features of future contracts and standard options, and they allow investors and traders to speculate or hedge against future price movement of various assets, including commodities, currencies, and financial instruments. Like all options, they come in two forms, calls and puts. Each has a strike price and an expiration date. These options can be exercised anytime before expiration if they are American style, or only at expiration if they are European style. Upon exercise, the holder takes a position in the underlying future contract, which can then be held to maturity, closed out early, or allowed to settle. These are similar to index and equity options. The only difference is that in the case of futures options, the underlying is the futures contract. One futures options contract gives us the exposure to one future contract. So what are the advantages and disadvantages of futures options? First, we have flexibility. Traders can leverage various strategies involving futures options like buying calls, buying puts, writing calls and writing puts, among others. Each strategy has a different market outlook, from bullish to bearish and even neutral strategies. Then we have leverage. Similar to futures, options on futures offer the possibility of high returns due to the leverage they provide, and then limited risk for buyers. For the buyer of an option, the risk is limited to the premium paid for the option. Unlike futures where potential losses can be substantial, an option buyer can't lose more than the premium they paid. Now let's break down how futures options work. Consider buying a future contract on crude oil. This contract commits you to purchase a set amount of oil, typically 1,000 barrels, at a predetermined price on a future date. Imagine the price per barrel to be around $90. This would give you an exposure per contract of $90,000. If the price moves by 1 point, your profit or loss will be $1,000. So as you might imagine, this can be daunting for retail investors due to the significant exposure and potential for substantial losses. Now let's discuss why futures options are so important and the difference between spot options. First, consider the 24/5 trading capability. Futures markets operate around the clock for 5 days a week, facilitated by exchanges such as the Chicago Mercantile Exchange and the Intercontinental Exchange. But what is the advantage of 24/5 trading? Global events don't wait for market hours. With 24/5 trading, investors can immediately react to international developments and economic news anytime they occur. This flexibility allows traders from different time zones to engage in the market when it suits them best, enhancing liquidity and participation. Consider the impact of key economic indicators like the CPI data, which is released at 8:30 a.m. Eastern Time, before the market opens at 9:30 a.m. On April 10th, for example, CPI data crucially influenced market expectation regarding Federal Reserve actions. If we look at this chart, we can see that the market drops almost 2% on the news. Futures and futures options allow traders to respond to this information almost immediately, capturing opportunities created by market reaction to such data releases. The same principle applies to after-market trading. When a company like Apple or Microsoft releases their earnings, they typically do it after the market is closed. Futures options enable trading on this information before the next day market opening, avoiding the risk associated with the price gaps at the open. If a big company has bullish earnings releases, the index future typically tends to move very fast. Microsoft, Google, Apple, and Tesla account for about 18% of the S&P 500 and about 25% of the Nasdaq. So a strong move in the price of these companies will move the market. And with futures options, you can capitalize on this. And this is why we're here today. We want to show you what we have done. At MenthorQ, we understand the complexities and rapid movement of the futures options market. That's why we are excited to introduce our latest product development, gamma and liquidity levels on futures options. These levels can be used if you are trading directionally by buying or selling futures, or if you want to use futures options within your strategy. They will provide a clearer path. Have you ever felt lost when looking at the chart, not knowing which side of the trade to take? Have you lost money on fake pullbacks or trend reversals? And how many times did you make too many trades because you believed your idea was right, but the market simply did not react? This is called revenge trading and can be very dangerous. Let's look at this chart. This is the MenthorQ net gamma exposure chart that shows market positioning on the Nasdaq future. The red bars highlight a large amount of put positioning. This brings us to gamma levels, and now we can leverage the information coming from the options market. This brings us to the basics of options. A put option is basically a safety net or an insurance that allows you to sell your stock at a predetermined price, even if the market price continues to drop. And what if you knew that on the other side of the trade there is a market maker that provides the price? Market makers are key to the market. They are always there, ready to buy or sell stocks or options, ensuring that there is always enough liquidity to keep the market running. In the case of options, the majority of transactions are executed by a market maker. Market makers don't really care whether the price of a stock goes up or down. The market maker does not make money from trading, but from executing trading volumes and charging a bid-ask spread. This concept is really important. So by doing this, market makers take on the risk in case the price of a stock moves. But they don't really want to gamble on whether the stock will rise or fall. Their job is to facilitate trades and provide liquidity. So if a lot of investors start to buy put options because they're worried the price of a stock might go down, what does that mean for the market makers? Well, if the market really starts to fall, all these investors will want to use their put option to sell their stock at the higher price, which could potentially put the market maker in a tricky situation because they have the obligation to buy these stocks at these prices. By selling put options or the insurance, market makers are now forced to buy the stock at higher prices. If the market keeps dropping, they might have to buy a lot of stocks at prices much higher than the market value, which could mean greater losses. To protect themselves from losing money in this scenario, market makers use a strategy called delta hedging. In the simplest form, that means that the market maker is always hedging its portfolio. As we said before, they are not making money on directional movement, but by executing trades and charging the bid-ask spread. To hedge against movement, they delta hedge their portfolio by buying or selling the underlying asset. This topic can be complicated, but we have a free documentation within our website under the resources section. This activity is like their own insurance. It allows them not to lose money when the market falls. They do this by making their own set of trades that balance out the risk they are taking when they sell put options. If the market drops, these balancing trades help them not lose out because they have other positions that gain value. They want to keep a risk-neutral position. This concept can be quite complex, but in simple terms, knowing where the market is positioned on the put or call side allows us to identify those reaction zones that will become very important as the price approaches those levels. We know that if that happens, those options that were previously out of the money are now in the money, and the market makers will react to protect against losses, and these reactions could add or remove liquidity to the market. It's time to introduce you to gamma levels and how they can help you within your trading plan. We know that the option market has become increasingly important for different reasons. The increase in option volumes can increase or reduce liquidity in the market, and being able to track the liquidity can help you increase profitability or risk management. Option flows creates technical moves in the market because of how market makers have to hedge their risk. Understanding options positioning is key for anyone who is trading stocks, futures, or options. Now let's look at some examples on using gamma levels on futures. But what are gamma levels? They are key price levels where there is more negative or positive gamma based on option positioning and open interest. By looking at the option data, we can define sticky price levels that can help us define our trading plan. They are reaction zones where the market will react if the price approaches the level. Here we can see how we can define those levels by looking at our net gamma exposure chart. If we go back to the example of you driving at night with only the front light of the beam, gamma levels help you understand what is going on around us and how the market is reacting. They are not a crystal ball and cannot predict the future. They provide us with a statistical advantage that allows us to improve our strategy. Remember, there is no model in the world that can predict the future. What we have developed is a system that allows us to translate the information contained in the option market into actionable information. We then simplify the data and plot it into the chart, giving you a clearer picture of what is around you. But why are they called gamma levels? Gamma is a measure of the rate of change in an options delta with respect to the change in the price of the underlying asset, and it's key in the delta hedging activity of the market makers. The overall gamma exposure in the market can be positive or negative. But why is this important? Because, as we explained earlier, the market maker is constantly hedging his portfolio by buying or selling the underlying asset. The overall gamma exposure will affect how the market maker is hedging, and this will have an effect on the price action in the market. Let's try to simplify this in a few sentences. The difference between positive and negative gamma is another important aspect to understand market dynamics. We know that in positive gamma, the overall market is long options. The market makers buys when the underlying falls and sells when the underlying goes up. This is how they stay delta hedged. This activity keeps intraday volatility low, and knowing how volatility will be before the market opens is a very important clue for a trader. And remember, to be successful, you need to trade in the right direction of volatility. In negative gamma, instead, the market makers hedges by selling the underlying when the price falls and going long when the price goes up. This creates more volatility in the market, and when we are in negative gamma, we can see big price swings during the day. Again, an important clue for a trader. We have simplified this, and every day you can check the gamma condition of your asset within the premium membership before the market opens. With the MenthorQ levels indicator, you can now add gamma levels to your charts, adding a clear picture of the market and better signals for your trades, take profit targets, and stop losses. Gamma levels are divided into primary levels and secondary levels. Let's start with the primary levels and are called the resistance level. The core resistance level is the price level with the most net gamma when it comes to calls. Generally, this is the level with the most upward resistance. Let's take the MenthorQ net gamma exposure chart to better understand why this level can become a reaction zone. The core resistance level is the strike price with the highest net call gamma. This is represented by the wider green bar. This also means that this is the level where there is the most call open interest and call gamma. Investors have been buying out of the money call options at that strike price. But why does it become a resistance level? If we think about market mechanics, we know that the market maker is going long to hedge against the investor call options. As the spot price moves closer to the core resistance levels, those calls that were previously out of the money start moving into the money. At that point, investors that were long out of the money call options start closing those positions. And the reason is obvious. If you're long an out of the money call option, you want to monetize it when it moves into the money, whether you're a hedger or a speculator. That is the main reason why the core resistance becomes a resistance. As investors close those call options, market makers will also adjust their delta hedges. Remember, market makers were going long to hedge those calls. Once those calls have been closed, the market makers has to close their long exposure, and this stops the market from moving above this level. Now, can the spot price break above this level? It can indeed, but it requires a further catalyst. Let's take the example of GameStop in 2020, when investors were buying calls, forcing the market makers to continue to go long to remain delta hedge. That was a bullish force on the market that kept forcing the market higher. So how can we use this level in our trading? Similar to how you would use a resistance in technical analysis, our core resistance can be used in the same way, but it encompasses the power of options data. We can use this level as a resistance or reaction zones where the price slows down its uptrend and can bounce to the downside. If you are in a long trade, you can use this level as a profit target area, and if you're looking for a reversal trade, this can be an efficient level of entry. The core resistance can also be an inflection point for an acceleration to the upside, similar to the GameStop example. If there is a bullish sentiment in the market, a break above the core resistance level can bring upside momentum. Let's look at this chart. This is the chart of Nvidia at the end of March 2024. We are in a strong uptrend, and on March 26, the price is approaching the $1,000 mark. Here we see the net jacks or net gamma exposure chart from our models, and we can identify two key levels, the core resistance and the core resistance 0 DTE, which looks at the market positioning at the next weekly expiration. The 1000 level and the 950 level are the one with the highest exposure. As we can see from the chart, the price reaches this level and then retracts, if faced to break above. Another important level is the put support. The put support level is a strike with the highest net put gamma. Generally speaking, is the level with the most downward support. Let's take the net gamma exposure chart to better understand why this level can become a reaction zone. The put support level is a strike price with the highest net put gamma. This is represented by the wider red bar. This is also the level where there is the most put open interest and put gamma. Investors have been buying out of the money put options at that strike price. But why does it become a support level? If we think about market mechanics, we know that the market maker is going short to hedge investors' put options. As the spot price moves closer to the put support level, the puts that were out of the money start moving into the money. At that point, investors that were long those out of the money puts start closing those positions. If you are long out of the money puts, you will start to monetize them as they become in the money. As investors close those puts, market makers will also adjust their delta hedges. Remember, market makers were going short to hedge those puts, and as the puts are closed, the market makers close the short exposure. That stops the market from moving below that level. The price can definitely break below this level. We have seen that happen before. But that would require a further catalyst. An investor will need to buy put option below the current level, driving market makers to continue to short the market to stay delta hedged. This brings us to the HighVol level, or HVL. The best way to understand this level is by taking the net jacks chart and looking at the jack slope in yellow. If you follow that curve up and down, you can see that it tracks the cumulative jacks. Said it more simply, the line helps us understand when we are in a positive or negative gamma environment. The HighVol level tells you at which point the slope of the jacks profile starts changing from positive to negative and vice versa. For example, if the spot price starts moving towards that level, we start seeing an increase in price volatility because it means that the market is increasingly moving towards the negative gamma environment. The opposite happens when the price moves higher from a negative gamma environment towards a positive gamma environment. Above or below that level, market makers may change the way they hedge. In a negative gamma environment, market makers accentuate volatility. For traders, understanding this volatility shift is very important because it will also affect the type of strategy you should use. Remember, to be successful, you always need to be on the right side of volatility. Then we have our one-day expected move indicator. The goal is to forecast the next day price action. It has an upper and lower band, the one-day max and the one-day minimum. The one-day max is the maximum price move that, according to the indicator, can be expected for the next day. The one-day minimum is the minimum price move that, according to the indicator, can be expected for the next day. So now you might be asking, does the indicator actually work? And how is it possible to forecast the next day price movement and volatility? The indicator is backed by data. We have backtesting results on our website. For example, if we look at the SPX index, here are the results over a 4-year period. What we found very interesting was the directionality. The one-day expected move indicator worked better than we expected. The price of the SPX closed above the one-day minimum on 87.62% of the time and closed below the one-day maximum on 85% of the times. By knowing this, you can now use a quant data approach to your trading. We see a similar results also on stocks. Here you can see some of the backtesting data on some of the most traded stocks. You can also find this data on our website. On top of the primary levels, we have the secondary levels, which are the JAX level 0 to JAX level 10. They represent the bars with the highest gamma exposure, as we can see from the net GAX chart. Similar to the primary levels, they represent reaction zones. You can plot them on the chart by using our TradingView integration. You can find the levels within our premium membership. Now let's look at some examples on using gamma levels on futures. The first thing we want to look for is the net gamma exposure, or the net GAX chart. The chart will show you the net gamma exposure at different strike prices. We want to understand market positioning and where market makers might need to hedge their books. Then we want to look at the net JAX multi-expiration chart. Here we can plot up to 4 expiration dates in the future. We want to look for 0 DTE flow, next expiration, and expiration with the highest JAX. This chart is key to help us understanding market sentiment and exposure. Once we understand positioning, we can start plotting the levels on the chart. You can find these levels within our Discord server. For example, on April 17, 2024, these were the levels for NQ and ES futures by looking at their option chain. We can then plot this level by using the MenthorQ levels indicator for TradingView. Now let's start with NQ. In this chart, we can see how the session opened. The JAX level acted as resistance and could provide a clear signal for a short trade. Now that you are in your trade, how would you play this move? First, we saw a strong bearish momentum and the price moved lower towards the one-day minimum. The price failed to break down and pull back. The breakout from below to above the one-day minimum could have provided a nice signal for a long trade. The price then reached the next level and pulled back to continue its downward move, closing right at the one-day minimum for the day. Adding the level to the chart in this example can provide us with a clearer path for our trading plan. Now let's do the same for the ES futures. The breakout of the JAX level 2 could have provided a strong bearish signal. The price then has a strong momentum until it reaches the one-day minimum. This exact level stops the break and pushes the price higher to the JAX level once again. Now let's do another example on the ES future. Let's look at the price action for April 15, 2024. If you look at this chart, what would you do? Would you go long or short? We see a breakout of a previous technical level, so we could consider going long. Now we can add the MenthorQ levels. The price is hitting the one-day max level. This can give us a clearer picture of the market. We can also overlay it with our technical indicators for confirmation. We can now plan this trade a little bit different. We can plan our short trade instead of going long. The levels work perfectly and we see a strong move to the downside. The price moves all the way down to the one-day minimum for the day. As a takeaway from all these examples, you can now add additional insights to your chart. We simplify complex model to allow you to quickly visualize what future option market is telling us. As a trader, you need actionable insight and easy to understand levels that can give you an edge when trading. These levels can also help define your plan and where the market could go. So what futures are we going to cover during this product release? We will provide futures levels on the following tickers going forward. As you can see, now you can leverage future options on index futures like ES, NQ, and Russell, commodities like oil and natural gas, metals like gold, silver, platinum, and copper, soft commodities as well as rates and forex. Now, before we go into the product demo, we want to share the feedback from some of our customers and how they're finding value from MenthorQ.
Hi, my name's Anthony Cordelli, and I have been an independent futures trader and member of the Chicago Mercantile Exchange since 1999. I started trading the S&P 500 futures pit, and I've been trading the E-mini S&P futures electronically since the late 90s. I use the MenthorQ daily gamma levels every single day in my morning preparation because I have to know what's happening in the options market. Even though I am primarily a futures trader, knowing what's going on and key levels that are happening in the options market are massively helpful for my daily execution trading the E-mini S&P 500 futures or any index futures markets that I am trading. This even goes for commodities such as crude, natural gas. The options markets these days continue to grow, and they are a main driver of daily price action. Therefore, I rely on MenthorQ's daily gamma levels to help give me an edge in my day trading.
Hi, everyone. My name is Anne-Marie Band. Many of you know me from StockTwits. You know me from uh, X, or you've seen me on the Place Your Trades Network, where we trade lots of futures and futures options, or you may have seen me on Top Step TV. The bottom line is, you know, if you've seen me, that I trade a lot of futures and I trade futures options as well. One of the reasons I love using MenthorQ is because of all the support with the absolute levels exactly when I need them. You can get those a variety of ways. You can join the free Discord. You can copy them from the morning review letter that comes out every day. Those can go right into TradingView, and just like that, I can stare down anything that I'm watching from the space, and I know where all the key levels from the option spaces look. So whether it's the ES, whether it's the NQ, whether it's the YM, or any kind of instrument that you are looking at in the future space, because more and more come online, you can simply pop these up and you know where the action is going to be. You know that if it moves past that level, you're going to likely have acceleration. If it bounces, it's going to move into that next level. And wow, do I love setting alerts on these. It really helps my trading day, and I love this product.
My name is Patrick Peterson. I'm a professional day trader since 2006. I'm focused most of the time on NQ and ES, especially on the futures. For me, I find it very helpful to use MenthorQ because of two reasons. The number one, and this is the biggest thing for myself, is the 1 day expected move, which was calculated based on the volatility. It gives me a clear overview where can the market go to the upside and to the downside. And this is something where I will never miss anymore. The second thing is the 0 DTE price levels. All the people know that the 0 DTE becomes more and more important. For this reason, for me as a futures trader, I love to have this on my chart, to see this as support and resistance, to see this as entry and exit points, and also based on the risk management, how I can size up my position. And this is so helpful, and I'm very thankful for the good job what MenthorQ is doing.
Hello everyone, my name is Steve. I've been in the profession of trading and investing for over 12 years now, and I would say it has been tied into my soul ever since I was old enough to open up my first trading account. I currently trade only the top tier 1 indices such as SPX, NASDAQ, and Dow Jones. My focus has always been to catch the major move of each day, and with the help of MenthorQ, I am able to unlock important daily zones that hold the greatest amount of options exposure. These levels that are updated daily can help greatly with one of the most important factors that beginners and also experienced traders struggle with, which is patience. Large market exposure offers you an extra confirmation in order to put your theory at ease, in order to not rush into bids without analyzing your own proper risk management. In my opinion, candlesticks alone will never offer an edge in the long run, so it's important for traders to master market positioning and to be prepared when the tide is turning. Thank you everyone. Hope to see you in the chat, and big thanks to Fabio and the MenthorQ team. Thank you.
These are some examples of the value we are providing on a daily basis to thousands of users. It is now time to show you a demo of our premium membership. Within our premium membership, you have access to our bots, where you can get our data, gamma levels, and quantitative models, as well as accessing our community and our trading rooms. We have a team of professional traders that are helping our members by showing how they read the market by looking at data. We have trading rooms dedicated to different strategies, from futures trading to scalping to selling spreads for income and macro. It is now time to go into the live demo. Welcome to the MenthorQ product demo. Within the MenthorQ Premium membership, you will get access to our models and our technology. We use the same approach used by large institutions, which is a data-driven approach where we simplify complex datasets and create actionable signals that can help you improve your performance and manage your risk more effectively. By signing up for the premium membership, you will get access to our premium Discord server, as well as all the tools available within our website. You will also get access to our gamma levels and models on stocks, ETFs, indices, crypto, and futures. Then you will get access to our option screeners, our community, and our trading rooms. We help thousands of investors that are leveraging our platform every day. Let's start. On the left-hand side, you can find all the different channels. We have divided them into categories. First, our welcome and help section. Here you can find the rules, any announcements, our terms and conditions. You will also get access to our resources where we will explain how to use our models and all the link to our guides within our website. Then you can access our trading view indicators and all the videos related to it and access our academy as well. All our resources can be found within our website under the resources here and guides, and they're divided into different categories. From the getting started section, you can see how to set up your premium membership and how to use the bots. We have our trading view indicator here, all the MenthorQ data, so all our key levels and how to use them. We have some interesting case study on how to leverage the data on different assets like stocks, futures, and others. We show you why the option market is so important. There's different documentation here. Then we have access to our models, so like our CTAs and volatility models. And then we show you different trading strategies that you can apply within our data set. Under our free section, you can find our daily note and our research. You can get access to this directly via email or through Discord. You will receive a daily email with our research on any topics that will be impactful for the day, like liquidity, macro events, and more. Then we have our premium section where you can access our bots and our models, and you can find it directly here on the left. The bots are divided into two types, auto post bots and query bots. You can access our channel on specific assets or models. We have dedicated channels for various stocks, ETFs, and futures. The bots will auto-post content on a daily basis, and a user can come here and access our models on the asset. Let's look at the SPY, for example. Here you can see the date and a series of commands that gets populated here every morning. The bots typically update before the market opens to allow you to prepare for your morning routine. Let's look at the data and the different charts. We start with our liquidity snapshot. Here we want to see the gamma condition and the volatility of the asset for the day. We also want to understand the expected move for the day on the asset. Knowing the volatility of the asset is a very important piece of information. In positive gamma, we can expect a lower volatility, while in negative gamma, we can expect a higher volatility and larger price swings. This can define which strategy to take for the day. Then we move to the main chart, where you can see our key levels. Here we see the primary levels, or the core resistance and core resistance 0 DTE, the put support and put support 0 DTE, and our HighVol level. To understand this level, let's see how they can appear on the chart. The core resistance is the level with the most upward resistance and highest net call gamma, while the put support is the level with the most downward support and highest net put gamma. Then we have the HighVol level that defines the gamma shift between positive and negative. Within our guides on our website, you can find all the documentation about the different levels and how to use them for your trading. We then have our key levels tables where we can find important information for the day, like the expected move, the open interest and volume, the JAX and DAX data, and put call ratios. Scrolling down, we have our trading view inputs that you can use within our indicator. We're going to show you how to integrate the data into TradingView very shortly. Now we can move to the net gamma exposure chart. What this chart does is calculate the overall net market exposure on the asset by looking at the options data. It calculates if we are in positive or negative gamma and the gamma exposure at different strike prices. We know that if there is a large gamma at a specific strike price, this will represent a reaction zone if the price reaches these levels. This chart also allows us to understand if the sentiment is bullish or bearish on the asset. Wide green bars represent a large options positioning on the calls, and wide red bars indicate a large positioning on puts. We also want to monitor the daily change in the positioning and how these levels shift up or down. The net JAX chart calculates gamma exposure by looking at all expirations down the option chain. We do the same for single expiration by looking at the multi-expiration net JAX chart. Here we can see multiple charts with different expirations from 0 DTE to monthly. We can continue to scroll down and find all our different charts and models. We have over 50 plus commands available for you in our bots. Now, what if the stock or asset you want is not within one of these channels? This is why we have our query bot here. The query bot allows you to request the data you need on the assets that you care about. To activate the bot, you can press the / command. Here you can see all the list of commands appearing at the top, and if you want to get the full list, you can type help and press enter, and you will get the full list of commands here. We also have documentation on our website with a full list of commands and a video on how to use the bots right here. So to use the bot correctly, we can activate it by typing the / command. Then we can start typing a keyword like, for example, JAX, and you see a list of commands appearing here. We need to click on the command that we want, and the word ticker will appear. Now we can type in our ticker and press enter. Now let's do some example. I want to look for a net positioning on an ETF like the QQQ. So I would type in my JAX command, and I would type in the keyword JAX and select the net JAX command and then type in QQQ. Here I can see the data, and I can see some red bars at the 430 levels and some green bars at the 445. I can read the data here, I can read the levels, and I can also go back in time. So here I have some backward arrow that I can use to go back to see how market positioning has changed over time. We can use the same thing on other commands like the metrics, our net JAX multi-expirations, and so on. So here you can get the data, you can go back in time and see how positioning has changed day by day. So this is very useful to understand, the delta change on market positioning over time. Let's try some other commands like the key levels table for another stock like Apple, or the liquidity snapshot on a company like Boeing, for example. Now let's look at how to get the trading view levels for a stock or asset you care about. We can get the levels in multiple ways. First, we can go on our auto post channels here, find the asset we care about, and go and copy the text of the trading view commands. Here we can simply copy the text here, go to our trading view indicator, which is the MenthorQ levels, and then our levels will be plotted on the chart. So if we type the ticker Tesla, you will see the levels here. Another way is to use our query bot. Here we have single ticker commands, so we can type in our levels command and we can get our trading view levels on any companies we care about, like this. We can again copy and paste and then go back to our indicator and add the levels to the chart. And simply by doing this, we can then access the levels on different stocks and ETFs. Within the bot, we can also get levels for multiple tickers simply by typing the list commands. I click here and I can type in multiple tickers at the time. Then I can simply copy and paste the text and go back to my indicator and paste the text in the input box here. By doing that, I can then scroll to the different tickers and see that the levels are plotted in the charts. So now you're active on your day in less than 30 seconds. We are excited to releasing our models on futures options, and we are the first company to provide these models by looking at the futures option chain. We are going to cover the following markets: indices like ES and Q and Russell, energy like crude oil and natural gas, metals like gold and silver, rates, forex, soft commodities, and more. But why futures options? While you can get a proxy to get gamma levels on futures by using the index or ETF, this is not clean data. Let me give you an example. Before this product release, to get gamma levels on crude oil, we could have used the ETF like the USO, but this is not the representation of the market and does not provide a clear picture. Most volumes on crude come from the future and not the ETF. And the same can be done for gold, where we could use the options on the ETF to estimate those reaction zones, but the data is simply not accurate. Futures have their own option chain, which is separate from the index or ETF one. So there is a lot of value in this data, and this is why we are excited to provide these levels to you. Within the premium membership, you will find a dedicated sections on futures, where we will post like all the different content on indices, commodities, metals, rate, forex, and soft commodities. This will update on a daily basis. You will also be able to access the data by using the query bot, and let's make an example. For example, I will be able to get the net GEX chart on a futures like the NQ, get the trading view levels for my tickers, and look at volume and open interest, for example. By simply typing a command, I am now active in the charts in a few steps. But the membership is much more than quality data and advanced models. We now have the best community of active traders and investors, thousands of users that use our server every day. You will be able to access our premium chat and access our community directly. You can now trade together with other professional investors. On top of that, we now have different trading rooms. We have our trade structuring channel where we look at the MenthorQ data and how to leverage it for your setups on a daily basis. Then we have our macro channel where our traders will go into macro events, economic releases, inflation data, rates, and much more. We then have 2 trading rooms dedicated to 0 DTE options. In the Iron Condor room, our traders will look at MenthorQ levels to sell credit spreads during the day on 0 DTE options. Then we have our scalping room where our traders will look at 0 DTE SPX options. We then have our swing trading room where we look at more long-term strategies like 30 DTEs, 20 DTEs, and so on. And then finally, we're excited to launch our futures trading room that will be focused on ES and NQ. So by accessing the premium membership, you will have access to our professional traders that have over 20 years experience in the business. On top of all these tools available within Discord, by signing up for our premium membership, you can also access our premium resource within our website. Here you will find guides, videos, research, and access to our option screeners. Stock screeners are tools that allow investors to filter and search for specific assets that meet the predefined criteria. These criteria can be based on various factors, including fundamental, technical, and other quantitative parameters. With the MenthorQ screeners, you can now receive a daily list of stocks matching quantitative filters. By leveraging our quantitative models, you can now find the most relevant asset and enhance your research. You can filter stocks based on a specific gamma level that you like, but you can also find more advanced screeners and look at, for example, volatility, open interest, and more. This concludes the demo of our premium membership. The product is evolving daily and you will see more features and models being added. Our goal is to keep providing you with value and actionable insights. Thank you all for joining us today. We are very excited for this product launch and this will be a game changer for retail traders. Let's quickly recap the key takeaways from today's discussion. We have seen the importance of future options. We showed you how to benefit from leveraging gamma levels on futures and how to get a clear picture of the market. Then we have introduced you to our premium membership and the feedback from our customers. If you enjoy this content and you would like to stay updated with our daily insights, join our community for free using the link below. And don't forget to follow us on Twitter. We post insights and models on a daily basis. If you want to access our data and models, you can join our premium membership. So check your email or the information below. Thank you once again for spending your time with us today. We are excited to see where your journey will take you, and we hope to see you within our premium membership.